This company is currently trading at one of the lowest PE ratios in its entire sector. It holds a monopoly in several categories, dominating the market with a presence that is so wide that you'll rarely walk into a grocery or a departmental store without spotting at least one of its products. Yet, despite the dominance, this stock has delivered a negative return of 4.5% over the last 1 year, even underperforming the Nifty 50. But here's where things get interesting. In the past 3 months alone, the stock has surged nearly 19%. The company in question is Zydus Wellness. So is this a turnaround story in the making? Let's dig deeper. To understand the stock's movement, we first need to understand what is happening in Zydus Wellness's business. Zydus Wellness is a publicly listed subsidiary of Zydus Life Sciences, which is a part of the Zydus Group. Zydus Wellness began its journey back in 1988 with the launch of sugar-free, India's first zero-calorie sweetener. Since then, the company has steadily expanded into the broader wellness space, building a strong portfolio of well-known brands such as Right Bite Max Protein, Complan, Glucon-D, Nutralite, Everyuth, Nycil, and so many more. All of these are household names in India. Zydus divides its business into two main segments: food and nutrition and personal care. Across each category, the company enjoys a strong market presence. Let's break down the food and nutrition portfolio first. 1. Sugar-free. This is the heart of Zydus Wellness. It commands a massive 96% share of India's sugar substitute market. With consumers increasingly shifting towards low or no sugar lifestyles, the category is enjoying a strong tailwinds. Spotting this trend early, the company has already launched several new variants to meet the different consumer needs. The management expects this category to grow in double digits in the coming year. Number 2. Glucon-D, a brand filled with nostalgia and still relevant. It holds a 59% market share, but it's important to note that its contribution to overall revenues is small.
The product is highly seasonal, with most sales occurring in the summer
in Q4 and Q1. Number 3. Complan. It currently holds a 4% market share. Back in 2010, Complan had about a 15% market share, but things slowed down. Zydus acquired it in 2019 for 4,595 crores, and it's been a slow burner since. That said, it plays a critical role in the company's international growth. Sugar-free and Complan together account for 85% of Zydus's exports. Number 4. Nutralite. This includes spreads and products like ghee and others, which is a steady contributor. Now, let's look at the personal care segment. 1. Everyuth, a familiar name in the Indian skincare space. 2 of its products lead their categories: peel-off masks with a 77.7% market share and scrubs with a 48% share. These products gain their highest market share across the company's entire portfolio. Number 2. Nycil, a summer staple with a 33% market share. It's in the prickly heat powder category. Summing up the segment performance. In FY25, both segments grew at a healthy pace. Personal care grew 33%,
food and nutrition
13%, and if you look at the image below, FY25's year-on-year growth in both segments had clearly outpaced the previous years. So clearly, the product portfolio is riding on strong tailwinds, helping Zydus deliver impressive growth across the board. That is the first key takeaway. But having a great product line isn't enough. What really matters is how it translates into financials. Here's a snapshot. Starting with the top line. Revenue increased from 2,328 crores in FY24 to 2,709 crores in FY25, up 16%, on the account of both the sectors growing strong. Net profit also saw a meaningful jump, rising from 260 to 347 crores, which is a 30% year-on-year increase. Overall, the earnings growth was broad-based and healthy. On the margin front, we're seeing some early signs of recovery. Operating margins improved slightly from 13% to 14%, while net profit margins expanded from 11.5% to 12.8%. While these margins are still below the historical levels, the improvement versus last year is a positive sign. Coming to the cash flows. Cash flows from operating activities rose sharply from 246 crores in FY24 to 380 crores in FY25, which is in line with the growth in profit. However, investing outflows, 224 crores compared to 19 crores in the previous year, along with a larger financing outflows, resulted in negative net cash flow of 30 crore rupees for the year. On the balance sheet, the company reduced its borrowings from 329 crores to 188 crores, continuing its deleveraging path. Reserves also increased by over 300 crore rupees, reflecting the retained earnings. To summarize, FY25 shows a clear improvement over FY24, both in growth and profitability. Margins are stabilizing, core operations are generating higher cash, and the balance sheet has strengthened further with reduced debt. The future outlook and growth strategy. Zydus Wellness is betting big on new product development. They launched sheet masks under Everyuth's sugar-free delight cookies, a new stevia-based sweetener, and Vimax to target the energy and adult nutrition markets. They're also tapping into digital and quick commerce platforms to reach the premium urban customers faster. Strategic acquisitions continue to be a part of their playbook, with the purchase of Right Bite Max Protein boosting their position in the high-growth nutrition space. The company now aims to reach an EBITDA margin of 17 to 18% over the next few years, up from the current 14%. Valuation check. Despite all of this, the stock is currently trading at a PE of 37 compared to its median PE of 58 for the FMCG index. Post the recent correction, it's now back around its 5-year median PE of 36. So to sum up the whole story, here we are. The company has delivered its best YOY growth in 5 years. It has deleveraged its balance sheet. Valuations have corrected. That could explain the recent rally in the stock. But not everything is rosy. Two concerns remain. Efficiency metrics. Zydus Wellness delivers an ROCE and ROE of just 6%, among the lowest in the sector. Profitability over time. Over the last 10 years, the company has struggled to consistently convert a large share of its sales into profits, hinting at a lack of pricing power in the long run. In conclusion, Zydus Wellness has shown a solid growth, a strong portfolio, and good outlook for the future. The recent rally in the stock price is because of improved financial performance and a more favorable valuation. However, challenges remain, particularly in terms of efficiency and long-term profitability. As always, investors should weigh both the potential and the risks carefully before making any decisions.